Australia faces an imminent 40% to 50% surge in fresh food prices, dairy, fruit, vegetables, and perishables, driven by a perfect storm, global fuel shortages, skyrocketing fertilizer costs, and strained supply chains. This is Eric from Market Meridian Finance. The warning from the National Farmers Federation, NFF, is not a distant scenario but a near-term risk, as diesel and urea costs double in weeks. This report dissects the transmission mechanism, macroeconomic impacts, policy responses, industry winners, losers, and investment implications for Australian and global markets. We all know the trigger: global fuel shortage and Australia's vulnerability. Australia's fuel security is at a decade low: 36 days of gasoline, 34 days of diesel, 32 days of jet fuel, well below the IEA's 90-day mandate. Wholesale diesel in Adelaide has jumped 47%, farmgate diesel has surged from $1.77 per litre to over $3 per litre. Middle East tensions and Hormuz Strait disruptions have crushed refined product flows, triggering regional rationing and panic buying. Why agriculture is first to suffer? Australian farming is diesel-intensive. Tillage, harvesting, irrigation, cold chain logistics, and long-haul transport all rely on diesel. A 100% plus cost jump directly erodes farm margins, with no quick substitution. Rural communities face supply quotas, threatening planting and harvest schedules, transmission chain, fuel fertilizer farm costs, shelf prices. Fertilizer crisis amplifies pain. Australia imports two-thirds of urea from the Middle East. Its last domestic urea plant closed in 2022. Urea has hit $584 per ton, up 30% month-on-month and 50% year-on-year. Fertilizer accounts for 15% to 25% of broadacre and horticulture costs. Shortages will cut yields and force shifts to low-input crops, legumes, reducing overall supply. Then come to full-cycle cost push. The cost cascade is unavoidable: input stage, fuel plus fertilizer plus feed plus energy; a logistics stage, road freight, refrigeration, port handling; retail stage, labor, warehousing, shrinkage for perishables. Perishables have no inventory buffer. Price hikes will hit shelves within 4 to 8 weeks. When the 40% inflation call, what it really means. NFF's 40% to 50% rise applies to fresh perishables, not entire baskets. Staples, bread, cereals, meat, will rise 15%, 25%, processed foods 10% to 15%. ABS data shows food inflation at 3.1% YOY, January 2026. This shock could lift headline food inflation to 12% to 15% in H2 2026. Macroeconomic impacts: inflation, RBA policy and household stress. Inflation rebound risk. CABB, RBA's 2 to 3% target is at risk. Fuel and food are sticky. Second-round effects will lift services and construction costs. Markets now price a hold or hike in May 2026, delaying cuts to late 2026 or 2027. Household consumption squeeze. House market may be affected heavily, and may have chance to collapse in 2026. A typical family spends $2.60 a week on groceries. A 30% average rise adds $8.80 a week. Low-income households spend 25% to 30% of income on food. Demand for charities, discounted lines, and private labels will surge. Fresh produce intake will fall, raising public health risks. How about current account and currency? Australia is a net food exporter but a net fuels or fertilizer importer. Terms of trade deteriorate. AUD may weaken on growth and inflation worries. Export meat to dairy prices rise, supporting farmgate revenues but hurting domestic affordability. How bad the Australian agriculture will face: farmers, margin squeeze, structural shift, horticulture and dairy, most exposed to fuel fertilizer. Small farms face exit risk. Broadacre, wheat and barley see cost push but benefit from global tightness. Adaptive shift, legumes replacing urea-heavy crops, precision farming and solar irrigation accelerate. Then how about food retailers, like Coles, Woolworths and discounters? What will they react? Pricing power. Major chains can pass costs but face ACCC scrutiny. Category shift. Private labels and staples outperform. Fresh food volume drops. Efficiency race. Cold chain, route optimization, and local sourcing become key. Discounters, Aldi, IGA gains share as budget demand rises. And what agri-supply chain of logistics, cold chain and inputs can do. Logistics, higher rates but margin pressure, fleets face fuel rationing. Cold chain, critical for perishables, providers with scale and hedging outperform. Input suppliers, local fertilizer blending, biostimulants, and fuel storage benefit. Consumer then has only way to choose. Behavior reset, trading down, premium lines decline, staples and frozen food rise. Food service, cafes and restaurants raise prices or shrink portions, bankruptcies rise. Health, lower fresh produce consumption increases chronic disease risks. Policy responses from government, mitigation versus band-aids. Fuel security measures, 762 million litres released from emergency stocks, almost equals 5 days of demand. 60-day fuel standard relaxation to boost supply by 100 million litres a month. Priority access for agriculture and critical transport. But the limitation is short-term relief, structural import dependence remains. Agriculture and food support from local and central government may include farm input subsidies and low-cost loans for fuels, fertilizer, ACCC price gouging monitoring to prevent profiteering, local supply chain grants to cut transport reliance. But there are still some longer-term reforms need to plan. Rebuild domestic urea and refining capacity, renewable energy for farms and cold chains, or diversify fertilizer imports away from the Middle East. We also need to eye on global food versus energy correlation. This shock proves energy is the backbone of food systems. A sustained $100-150 BBL crude would lift global food inflation by 3-5 pp, threatening emerging markets. Australia as net food exporter, fuel importer, high income, exposed to Middle East flows. Australia's outcome will guide policy in the EU, UK, and Japan. We also need to focus on climate and geopolitics overlay in Australia. Drought, heatwaves, and floods already reduced yields. Fuels fertilizer shocks compound climate risks, creating a polycrisis for global food systems. Coming to investment implications for long-term themes include food security tech, precision ag, biologicals, controlled environment agriculture, energy independence, farm solar, micro-refining, modular urea, supply chain resilience, localization, cold chain automation, inventory tech. Talk about base, upside and downside scenarios. Base case, 60% probability, fuel tensions ease by Q3 2026, perishables rise 30% and 35%, food inflation peaks at 12% in Q3, RBA holds then cuts in late 2026, farm profitability mixed, retailers maintain margins. Upside case, 25% probability, rapid fuel supply recovery, targeted subsidies cap rises at 15%, 20%, food inflation moderates to 5% by year-end, consumption rebounds. And downside case, 15% probability, Hormuz closure extends, diesel hits for Australian dollars per litre, urea above $700 ton, perishables up 50% plus, headline inflation above 5%, RBA hikes, household stress, farm failures, and social instability rise. Now coming the result. Australia's 40% fresh food price warning is a symptom of a broken global system, energy-reliant agriculture, concentrated critical inputs, and fragile geopolitics. The shock will reorder farming, retail, and policy. Investors and businesses must prioritize resilience, efficiency, and domestic supply chains. For markets, the trade-off between inflation and growth has worsened. For households, the cost of living crisis enters a new phase. For policymakers, short-term relief must go hand in hand with long-term restructuring of fuel and food systems. In short, we all need to replan our life. Thank you for watching. Please give me a big thumb and subscribe my channel. This Eric from Market Meridian. See you in next video.